Imagine this. Your financial future doesn't have to be complicated. Let me show you how to build a smarter strategy today. You take $20,000 out of your retirement account for a trip with the grandkids. And the IRS treats it like you earned over $30,000. Your tax bill jumps. Your Medicare premiums go up, and it keeps haunting you for years. In the next few minutes, you'll see exactly how to avoid that. And which accounts to pull from first, so you keep more of your money, not Uncle Sam. Let's walk through this together, step by step. Once you stop working, your paycheck ends, but your need for a reliable paycheck does not.
In this video, you're going to learn how to line up your income sources in the right order.
How U.S. tax rules in 2025 and 2026 treat IRA, Roth, and brokerage withdrawals. How to avoid three big landmines: Social Security taxes, Medicare IRMAA surcharges, and painful required minimum distributions later in life. And to make this real, you'll see a detailed example of a couple in their late 60s. And how changing the withdrawal order gives them years of extra spending money. Stay with this until the end, because the last section gives you a simple yearly checklist. You can literally keep next to your tax return to stay on track. First, let's slow down and get really clear on what replaces your paycheck. For most Americans above 55, there are usually 4 or 5 main buckets of income in retirement. Social Security, any pension or annuity income, tax-deferred accounts, traditional IRA, 401 or 403, taxable brokerage accounts, joint or individual investment accounts, tax-free accounts, Roth IRA or Roth 401. Social Security and pensions are your fixed income. They show up every month, whether markets are up or down. And everything else you control. Your job in retirement is to create your own paycheck by filling the gap between what you want to spend and what those fixed sources provide.
Most people stop here and ask, which account has the most money? And pull from that.
That's exactly how people end up paying far more tax than they need to. Step 2. Understand your 3 biggest tax landmines. Before choosing which bucket to tap first, you need to know where the mines are buried. Social Security tax torpedo.
In the U.S., Social Security can be 0%, 50%, or up to 85% taxable at the federal level, depending on your combined income.
That's your adjusted gross income, plus any tax-free interest, plus half of your Social Security benefits. For 2026, if you're married filing jointly and your combined income is under $32,000, your benefits are not taxable. Between $32,000 and $44,000, up to 50% of your benefits can be taxable. Above $44,000, up to 85% of your benefits can be taxable. These dollar thresholds have not been indexed for inflation since the 1980s.
Which means more and more retirees are getting pulled into this tax every year.
That's why a small extra IRA withdrawal, say $2,000, can suddenly make an extra chunk of your Social Security taxable. And it can feel like your tax rate just doubled. Tax landmine #2. Medicare IRMAA surcharges. Only Alex speaks and lip syncs. All other characters keep their mouths closed. Says income-related monthly adjustment amount. In 2025, if your modified adjusted gross income from 2 years earlier is over $106,000 as a single filer, those surcharges can add hundreds of dollars per month per person when you cross a threshold, even by $1.
And remember, IRMAA looks back 2 years, so a big Roth conversion or IRA withdrawal in your late 60s can suddenly surprise you with higher Medicare premiums in your early 70s.
Finally, required minimum distributions.
Starting in your early 70s, age depends on birth year, the IRS forces you to pull money out of traditional IRAs and 401s each year. The more you have in tax-deferred accounts when RMDs start, the bigger the forced withdrawals. And the easier it is to trigger the Social Security tax torpedo and IRMAA all at once.
In a minute, you'll see how one couple uses their 60s to shrink those future RMDs and smooth out their taxes for life. Step 3. Know your tax buckets, in plain English.
Let's quickly translate the tax code into everyday language, so you can see why order matters.
When you sell investments here, you mostly pay long-term capital gains on the growth, often at 0%, 15%, or 20%, depending on your overall income. Deals. In 2025, married couples from filing jointly can have up to a day 6 700 qualified dividends.
Tax-deferred accounts. Traditional IRA, 401.
Every dollar that comes out is taxed like salary, ordinary income. In 2025, for married couples filing jointly, that 12% bracket run up to $25,100.
And the 22% bracket goes from $96,951 up to $206,700.
Tax-free accounts. Roth IRA, Roth 401.
If you've met the age and 5-year rule, qualified withdrawals are completely tax-free and don't count in the Social Security Combined Income Formula or IRMAA calculations.
Now think about this. The HISS is the KEE condition.
A dollar from your IRA might push you into a higher tax bracket, increase how much of your Social Security is taxable, and move you closer to an IRMAA tier.
While a similar dollar from your Roth might do none of that. So the question isn't just, where is the money? It's, which dollar does the least damage when I pull it out? Step 4. The general withdrawal order that usually wins.
Every situation is unique, but most U.S. retirees above 55 with multiple account types will benefit from a version of this order.
1. Use taxable brokerage and cash first in a smart way.
2. Do controlled IRA withdrawals and Roth conversions up to a target tax bracket.
3. Delay Social Security and sometimes pensions if you reasonably can. 4. Protect the Roth for last and for emergencies. Let's walk through how this often looks in your 60s. Ages roughly 60 to 70. The planning window. These are often golden years for tax planning. Your paycheck has stopped or dropped. Social Security may not yet have started, or you're delaying it. Medicare might not yet be applying IRMAA, especially before 63.
That means your taxable income is often lower than it will be in your 70s.
When RMDs and full Social Security are in play.
In these years, a common pattern is Cover your living expenses first from your taxable brokerage and any cash savings. Add just enough traditional IRA or 401 withdrawals or Roth conversions to fill up a low bracket, often the 12% or part of the 22% bracket. Here's how to think about it. Leave the Roth account untouched, so it keeps compounding tax-free. That's the strategic play, exactly. The goal is to smooth taxes out over your lifetime, not chase a zero tax year today and walk into a huge bill later. In a moment, you'll see a concrete example where this approach means the same couple ends up with hundreds of thousands more after tax over their retirement.
Tom and Linda, 67 and 65, a married couple in the US, recently retired.
Here's their picture. They want to spend $90,000 per year after tax.
They have no pension. Based on their work history, if they claim Social Security now, they'd get a combined $48,000 per year.
If Tom waits until 70, his benefit would be much higher.
They've saved $500,000 in a taxable brokerage account.
$700,000 in traditional IRAs and 401s.
$300,000 in Roth IRAs. They're healthy, expect to live well into their 80s, and like the idea of leaving something behind for their kids.
Phase 1. Early retirement before full Social Security.
Suppose Tom delays Social Security to age 70 and Linda to her full retirement age.
That means for the first few years, all of their income must come from savings.
Target: keep taxable income mostly within the 12% and lower part of the 22% bracket, using current 2025 married filing jointly thresholds. Each year they might pull a big chunk of spending money from the taxable brokerage account, realizing long-term capital gains that often fit in the 0%.
Add enough traditional IRA or Roth conversions to bring their taxable ordinary income up to the top of the 12% bracket.
Maybe a bit into the 22% bracket if the math still looks favorable. Why? Because right now they're in low brackets and they're not yet triggering the Social Security tax torpedo or IRMAA. By doing this, Tom and Linda are proactively shrinking that big pile of pre-tax money that would otherwise cause huge forced withdrawals and big tax bills in their 70s. Instead of the IRS deciding how much they must withdraw later, they quietly move money into their Roth accounts on their terms.
Phase 2. After Social Security starts.
At 70, Tom finally turns on Social Security at a higher monthly benefit, and Linda starts hers at her full retirement age.
Now their world changes.
They have a strong fixed income base from Social Security. They still need some extra money from savings, but not as much. More of each IRA dollar they pull, Miguel can now make Social Security taxable because of those fixed combined income thresholds.
So from this point on, the order usually shifts to: first, take any required minimum distributions from traditional accounts when they begin.
That's non-negotiable. This illustrates a long-term strategy with a delayed outcome.
If they need more than Social Security plus RMDs, fill the gap first from their taxable brokerage, being mindful of long-term capital gains.
Tap Roth only when needed to avoid jumping into a higher tax bracket or tripping an IRMAA threshold.
Step 4. The general withdrawal order that usually wins.
1. Don't blindly empty one bucket at a time.
It's rarely optimal to spend only taxable, then only IRA, then only Roth.
Blending them, guided by tax brackets and thresholds, usually wins.
2. Use taxable accounts and modest IRA withdrawals in your 60s to pre-shrink future RMDs.
If you can, fill up the 12% bracket and only carefully dip into the 22% bracket using today's 25 thresholds.
3. Know the Social Security tax thresholds and watch your combined income.
The data shows a significant opportunity here. This specific area represents a substantial financial advantage that you should consider.
Where up to 50% and then up to 85% of your benefits become taxable. 4. Before age 63, Roth conversions are often on sale.
Those are the years before your income starts affecting Medicare IRMAA at 65.
Which first kicks in for 2025 when your 2023 income is above $106,000 single or $212,000 married.
Only Alex speaks and lip syncs. All other characters keep their mouths closed. Says 5. Protect your Roth. Let it grow.
Save it for late life flexibility, big one-time expenses, and for heirs.
Because qualified withdrawals don't show up in your taxable income or IRMAA calculations.
If you remember only one thing from this video, take this.
The order you withdraw from accounts can matter more than the investments you pick inside those accounts once you're already retired.
Only Alex speaks and lip syncs. All other characters keep their mouths closed. Says, Step 7, Yearly Kitchen Table Checklist.
Here's a simple routine you can walk through once a year, maybe with a cup of coffee at the kitchen table or with your tax professional. 1. List your fixed income for the coming year. Your next step is to analyze your Social Security benefits.
Social Security, pensions or annuities, rental income or part-time work.
2. Decide how much you want to spend for the year. Be honest.
If you're going to see the grandkids, fix the house, or travel, include it.
3. Calculate the gap. Spending goal minus fixed income equals the amount you need to pull from savings. 4. Choose your target tax bracket for the year. Look at the current 2025 brackets, know roughly where 12% ends and 22% begins for your filing status. Only the explicitly defined audio track is allowed.
Only Alex speaks and lip syncs. All other characters keep their mouths closed. Says, 5. Fill that gap in this order most years.
Enough IRA withdrawals or Roth conversions to fill your chosen bracket without triggering more Social Security tax than necessary or crossing an IRMAA line.
The rest from your taxable brokerage, trying to keep most gains in the 0% long-term capital gains range when possible.
Only tap Roth if needed to avoid higher brackets or big jumps in Medicare premiums.
6. Recheck mid-year if something big changes. A property sale, inheritance, or large one-time medical bill can all change the optimal mix. Wise action now leads to comfort later. You've worked hard for your savings. Now, make your savings work hard for you.